welcome back to the deep dive. If you need a solid shortcut through the, let's say, the foundational logic of financial reporting, why the numbers are what they are and the rules behind them, well, this deep dive is definitely for you.
Yeah, the source material we're drawing on is pretty extensive. It's basically the academic roadmap covering everything from the basic definitions and the accounting cycle flow,
Right.
all the way to the philosophy behind it, the conceptual framework, and then some really critical practical stuff like cash management.
So our mission today is to take all that, those hundreds of pages maybe, and boil it down into the most, well, actionable knowledge nuggets.
Exactly.
We've sort of structured this around three pillars. First, the absolute bedrock, those fundamental assumptions and the key measurement principles. Second, we're tackling the why, the conceptual framework, the logic behind the accounting standards.
Yes, the reasoning.
And finally, we get practical, really drilling into the rules for cash and cash equivalents. But let's start right at the beginning. If someone asks, just plain and simple, what is accounting? What's the textbook answer?
Okay, well, it's essentially a systematic process. It involves 4 key steps: identifying economic events, measuring them, recording them, and then communicating that information.
And the whole point.
The whole point is really to allow users both inside and outside the company to make informed judgments and decisions based on that economic information.
Right. That decision-making aspect is crucial. And these users, who are we talking about? Our sources break them down pretty neatly, don't they?
They do. You've got your internal users, think management, employees. They're looking at planning, control, maybe job security.
Okay.
And then your external users. That's a wider group. Investors, lenders, creditors, even government agencies concerned with taxes and compliance.
That's a critical distinction, that diversity. It's precisely why we need this rigid, verifiable structure we're about to dive into, isn't it?
Absolutely. It underpins the whole system's credibility.
Okay, let's unpack this, starting with those 4 fundamental assumptions. These aren't like optional extras. They're the ground rules that make consistent measurement possible. First one, and maybe the trickiest for new business owners, is the business entity concept.
Oh, definitely. This one's non-negotiable. The business entity is completely separate from its owners, period.
So if the owner uses the company card for, say, personal groceries,
That's not a business expense. It's a withdrawal or owner's draw. That separation is absolutely vital for accurate financial reporting. You can't mix them up.
got it. Then we have the going concern assumption. We basically assume the business will keep operating indefinitely, right? Which affects how we value long-term assets.
That's the standard assumption, yes. We operate under going concern unless there's strong evidence to the contrary.
But what if things look shaky? What if that assumption seems wrong?
Well, that's where it gets serious. If a company is, say, facing liquidation, you'd have to ditch the going concern assumption. Then you'd value assets based on what they'd fetch now in a quick sale, which is usually way lower than their book value. It completely changes the balance sheet picture.
A huge difference. Okay, and since we can't wait forever for results, there's the time period assumption. We chop up the business's life into artificial chunks, months, quarters, years.
To get timely information out to those users we mentioned.
Makes sense. And the last one.
The monetary unit assumption, 2 parts to this. First, only transactions you can measure in money get recorded. Second, and this is important, we assume the currency unit the source mentions, the Philippine peso, but it could be dollars, euros, whatever, is stable over time. We don't generally adjust historical figures for inflation.
That sounds a bit risky, especially now. If you bought land decades ago, assuming the currency is stable means your books show a value that's, well, potentially misleading today.
It does. And that leads us straight into the key measurement principles and that classic trade-off accountants always face: reliability versus relevance.
Ah, yes, the historical cost principle.
Exactly. Assets are initially recorded at what you actually paid for them, their original acquisition cost. Why? Because that number is stable, it's objective, you can verify it with an invoice. Accountants love verifiability.
But the downside is obvious, like you said. It sacrifices relevance over time. Land bought in 1980 for $50,000 might be worth millions now, but the books still reliably show $50,000.
Precisely. We tend to prioritize that reliable, verifiable cost over a potentially more relevant but maybe subjective current market price, at least for many assets. There are exceptions, of course.
Okay, and then we have the timing rules, the revenue recognition principle.
This is, you recognize revenue when you've earned it, essentially when you've done what you promised to do, not necessarily when the customer pays you.
And its twin is the matching principle.
Right. You have to match expenses with the revenues they help generate in the same accounting period. Think cost of goods sold you. You match that cost against the sales revenue it produced in that month or quarter.
You don't want sales in December and the cost hitting in January.
No, because that distorts the profit for both periods. The matching principle gives you a true picture of profitability for that specific time frame.
Okay, let's touch on the workflow, the accounting cycle. We won't go through all 9 steps, but let's focus on where the real complexity often lies. Step 2 is journalizing. This is where the rules of debit and credit come in.
This is like the grammar of accounting. You just have to internalize it. Assets, expenses, and owner's drawings, they all increase with a debit.
Yeah.
Liabilities, equity, and revenues, they increase with a credit. If you can remember that structure for those 6 main account types, you can fundamentally record any transaction correctly.
DEALER. Assets, expenses, drawings on one side, debit increases. Liabilities, equity, revenue on the other, credit increases.
That's a common mnemonic, yes. Whatever works to lock it in.
Then we jump ahead to step 5, adjusting entries. This feels like the really crucial period end cleanup step.
It absolutely is. If we only recorded transactions when cash changed hands, our reports would be, frankly, a mess. Adjusting entries makes sure we follow those revenue recognition and matching principles we just talked about.
And they generally fall into 2 camps, right? Accruals and deferrals.
That's right. Think about the timing relative to the cash flow. An accrual is when the economic event earning revenue or incurring an expense happens before the cash moves.
Like providing a service but not billing yet.
Exactly. That's accrued revenue. Or you used electricity this month, but the bill hasn't arrived. That's an accrued expense. You record them to get the timing right.
And deferrals.
Deferrals are the opposite. The cash changes hands before the revenue is earned or the expense is incurred. A customer pays you 6 months' rent up front. You haven't earned it all yet, so it sits as unearned revenue, a liability.
Or paying insurance for the whole year in advance.
That's a classic prepaid expense, an asset. You defer recognizing the expense until the period it actually covers.
So accruals catch up with events, deferrals wait for events. Once those are done, we finalize statements and then do closing entries, steps 8 and 9.
Yep, the big reset for the next period. You only close out the temporary accounts, revenues, expenses, and drawings dividends. You transfer their balances, usually to retained earnings or capital, effectively zeroing them out.
So the next year starts fresh for income and expenses.
Exactly. The permanent accounts, assets, liabilities, and equity, they just roll over. The post-closing trial balance proves that only these permanent accounts have balances left.
Okay, one last thing in this section. Inventory systems for a trading business. The contrast between perpetual and periodic.
Right. Think of perpetual like a modern supermarket checkout scanner. Every time an item is sold, the system instantly updates the inventory count and records the cost of goods sold for that specific item. It's continuous real-time tracking. Periodic is more like doing a stock take in a corner shop once a month. Throughout the month, you just track your purchases. You don't know the exact COGS or inventory level day to day. At the end of the period, you count what's left, physical inventory, and then you calculate what must have been sold. Beginning inventory plus purchases, ending inventory equals COGS.
So much less precise during the period, only accurate at the end.
Pretty much. Perpetual gives you much better ongoing control and information, but it's generally more complex and costly to implement.
Okay, that covers the sort of how-to, the rules of the road. Now, let's talk about the logic, the why behind those rules.
Yeah.
The conceptual framework. Why do we even need this big overarching document? Why don't the standard setters like the IASB just write specific rules for everything?
Well, the framework serves a few crucial purposes. It's the foundation, the constitution, if you like, that guides the standard setters themselves when they develop new accounting standards. But maybe more importantly for practitioners, it provides a fallback. When you encounter a weird transaction or event that isn't covered by a specific standard, and that happens, the framework gives you the principles to figure out how to account for it logically and consistently. It fills the gaps.
And it states the ultimate goal pretty clearly, doesn't it?
It does. The primary objective is right there: to provide financial information that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity.
Usefulness is the key. Everything else flows from that.
Exactly. And to be useful, the framework says information must have 2 fundamental qualitative characteristics. These are the absolute must-haves, no compromises.
Just one, relevance.
Right. Information is relevant if it's capable of making a difference in the decisions users make.
How does it make a difference?
It has to have either predictive value, helping users forecast future outcomes, like future cash flows, or confirmatory value, helping them confirm or correct their past predictions or assessments, or ideally both. If it doesn't help you predict or confirm, it's just noise.
And materiality is tied into relevance, isn't it? It's like a threshold.
Precisely. Materiality is an entity-specific aspect of relevance. Information is material if omitting it or misstating it could reasonably be expected to influence the decisions that primary users make. It depends on the size and nature of the item in the context of the specific company's financial report.
So a $10,000 error might be immaterial for a huge, multinational, but highly material for a small local business.
Exactly right. Context is key.
Okay, so relevance is the first fundamental. What's the second?
Faithful representation. The information has to faithfully represent the economic phenomena that it purports to represent. Basically, does the report actually reflect what happened?
That sounds like it should be obvious, but what does it mean in practice?
It means the depiction has three characteristics itself. It must be complete, including all information necessary for a user to understand the phenomenon. It must be neutral, free from bias in the selection or presentation of information. You can't try to sway the user's decision.
And the third one is free from error. But hang on, accounting uses tons of estimates, depreciation, bad debts, warranty provisions. How can something based on estimates be free from error?
That's a really good question, and the framework addresses it directly. Free from error doesn't mean perfectly accurate in all respects. Obviously, estimates involve judgment and uncertainty.
Right.
What it means is that there are no errors in the process used to arrive at the number or description, and the process was selected and applied correctly. The description of the estimate also needs to be clear about the uncertainty involved. So it's about the process being error-free, not necessarily the final number being perfectly precise.
Okay, that makes more sense. So relevance and faithful representation are the must-haves. Then we have the enhancing qualitative characteristics. These are the good-to-haves that boost usefulness if the fundamental ones are met.
Exactly. They help distinguish between useful information that's merely acceptable and useful information that's exceptional. First is comparability.
Allowing users to compare apples with apples.
Pretty much. It lets users identify and understand similarities and differences among items. That could be comparing company A to company B, intercompany, or comparing company A's results this year to its results last year, intercompany.
And consistency helps achieve that, right? Using the same methods period after period.
Consistency is the key tool for comparability over time for a single company, yes.
Okay. What else enhances usefulness?
Verifiability. This helps assure users that information faithfully represents the economic phenomena it purports to represent. It means different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation.
Like counting cash is easy to verify directly.
That's direct verification. But verifying something like depreciation involves checking the inputs, the cost, the useful life estimate, the method, and recalculating. That's indirect verification. Both build confidence.
Got it. And the last two, enhancing characteristics.
Timeliness, getting the information to decision makers before it loses its capacity to influence their decisions. Old news isn't very useful. And understandability.
Meaning it should be clear and concise.
Yes. Classifying, characterizing, and presenting information clearly and concisely makes it understandable. But importantly, the framework assumes users have a reasonable knowledge of business and economic activities and review the information with reasonable diligence. It doesn't mean simplifying things to the point where they lose relevance.
Okay, let's quickly use this framework logic to define the core elements, the building blocks of financial statements. An asset isn't just stuff the company owns.
No, the definition is more precise. It's a present economic resource controlled by the entity as a result of past events.
A resource.
Meaning a right that has the potential to produce future economic benefits like generating cash inflows or reducing cash outflows. That potential is key.
And a liability.
That's a present obligation of the entity to transfer an economic resource as a result of past events. The key here is present obligation, a duty or responsibility the entity cannot practically avoid.
And income and expenses.
These are defined based on changes in assets and liabilities. Income represents increases in assets or decreases in liabilities that result in increases in equity.
Other than contributions from owners.
Crucially, yes. And expenses are the opposite. Decreases in assets or increases in liabilities that result in decreases in equity, again, other than distributions to owners. That distinction keeps owner transactions separate from operational performance, which is what profit measures.
Which brings us back full circle almost to measurement. We mentioned historical costs earlier, reliable but potentially less relevant. What are the alternatives under the framework?
The main alternative category is current value measurements. This aims for more relevance. It includes things like fair value.
What you could sell it for today.
Essentially, yes. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It's an exit price.
Okay.
Another one is current cost. This is more like an entry price, what it would cost to acquire an equivalent asset today. Or for a liability, the proceeds you'd receive if you incurred an equivalent liability now. Accounting standards often pick and choose between historical costs and these current value measures, depending on the specific asset or liability and the balance they want to strike between reliability and relevance.
All right, let's shift gears now to the super practical side, applying these rules to cash. It's the lifeblood, as they say, but also, because it's so liquid and desirable, it's the asset most vulnerable to, well, theft or fraud.
Absolutely. So nailing down the definition and controls is critical. First, what actually is cash for reporting purposes? It includes coins and currency on hand, money orders, certified checks, cashier's checks, personal checks received from customers.
Stuff you can deposit right now.
Exactly. And, of course, demand deposits, your regular checking and savings accounts at the bank.
And then there's this related category, cash equivalents.
Right. These aren't strictly cash, but they're very close. They are short-term, highly liquid investments that are readily convertible to a known amount of cash and subject to an insignificant risk of changes in value.
Okay, short-term and highly liquid. What's the specific rule there?
The crucial bit is the maturity. To qualify as a cash equivalent, the investment must have an original maturity of 3 months or less from the date of acquisition by the company.
3 months from when the company bought it. That's key, isn't it? So if a company buys a government treasury bill that matures in 6 months.
Not a cash equivalent. Even when there are only 2 months left until it matures, it still doesn't become one because its original maturity was longer than 3 months. It would likely be classified as a short-term investment instead.
Got it. So things like treasury bills, commercial paper, money market funds can be cash equivalents, but only if they meet that strict 3-month from acquisition maturity rule.
Correct.
What about things that look like cash but aren't? Like checks you receive that cause problems, say an NSF check. Not sufficient funds bounces back from the bank.
Definitely not cash anymore. The bank rejected it. You have to reclassify it, usually back as an account receivable from that customer. You need to go chase the money again.
And a post-dated check. Someone gives you a check dated for next week.
Also not cash yet. You can't deposit it until the date on the check. So until that date arrives, it's also treated as an account receivable.
Okay. What if your bank account goes into the red? An overdraft.
Generally, a bank overdraft is treated as a current liability. It's effectively a short-term loan from the bank. You wouldn't net it against positive cash balances in other accounts unless you have a specific right of offset agreement with that bank.
And sometimes cash is set aside for a specific purpose, right? Restricted cash.
Yes. If cash is restricted and not available for general use, maybe it's legally restricted for repaying a long-term debt, or set aside for future plan expansion, it needs to be reported separately. It wouldn't be included in the main cash and cash equivalents line item. It might be current or non-current, depending on the nature of the restriction.
Okay. Given how easily cash can disappear, internal controls are paramount. What's the single most important control procedure the source material highlights?
Without a doubt, segregation of duties, sometimes called separation of functions. Meaning no single person should have control over the entire cash process. Ideally, the person who handles the physical cash, receiving it, making deposits, should be different from the person who records the cash transactions in the books, and different again from the person who reconciles the bank statement.
So you build in automatic checks and balances. One person's work verifies another's.
Exactly. It makes it much harder for errors or fraud to go undetected. Another key control, especially for small cash payments, is the impress system for petty cash.
How does that work?
You establish a petty cash fund at a fixed amount, say $200. Employees use that for small incidental expenses, getting receipts, vouchers. When the cash runs low, the custodian submits all the vouchers, they're approved, and the fund is replenished by exactly the amount spent, bringing it back up to the fixed $200 level. The expense recording happens when the fund is replenished, not when the cash is paid out initially.
Keeps tight control over those small amounts. Okay, that brings us to the final challenge, the bank reconciliation. Why do we even need this? Don't the company's books and the bank statement show the same balance?
Ah, rarely. There are almost always timing differences in items that one party knows about before the other. The bank reconciliation is the tool we use to identify those differences and figure out the true, adjusted cash balance that should be reported.
So what kind of items cause these differences?
We usually categorize them based on whether they affect the bank balance or the book balance first. Items affecting the bank balance are things the company has recorded, but the bank hasn't processed yet.
Like checks you've mailed out but haven't cleared the bank?
Those are outstanding checks. They reduce the bank's perspective of your balance once they clear, so we deduct them from the bank statement balance in the reconciliation.
And deposits made late in the day that missed the bank's cutoff.
Deposits in transit. The company recorded the deposit, but it's not on the bank statement yet, so we add those to the bank statement balance in the reconciliation.
Okay, so those reconcile the bank side. What about items affecting the company's book balance?
These are things the bank knows about, usually appearing on the bank statement that the company hasn't recorded yet.
Like bank service charges.
Exactly. Or maybe the bank collected a note receivable directly on the company's behalf, a bank collection. The company needs to add that collection to its book balance. Conversely, bank service charges, or those bounced NSF checks we talked about earlier, the company needs to deduct those from its book balance. Bank errors can also happen, affecting either side.
So you adjust both the bank balance and the book balance until they agree.
That's the goal. You should arrive at the same adjusted cash balance starting from either side.
And here is the crucial step often missed. What happens after the reconciliation is done?
This is key. Only the items that adjusted the book balance require the company to make adjusting journal entries in its accounting records.
Why only the book side?
Because the bank side items, deposits in transit, outstanding checks, will eventually clear the bank naturally. The company doesn't need to do anything more. But the book side items, the bank charges, the NSF check, the collection represent real economic events that haven't been recorded yet. The journal entries bring the company's actual cash account ledger into agreement with the true reconciled balance.
So the reconciliation finds the problems, the journal entries fix the books.
Perfectly put. Hashtag hag outro.
Wow, okay. We've really covered a lot of ground there. We essentially did a deep dive into the very architecture of financial reporting. We laid out the basic rules and assumptions, the how of measuring and recording in segment 1. Then we explored the why, the logic behind it all with the conceptual framework in segment 2.
The foundation.
And finally, we applied those rules and logic to the practicalities and complexities of managing cash in segment 3.
Yeah, and understanding that logic, that why, is so important. It lets you go beyond just memorizing rules and actually think critically about the information in financial reports. Which brings me to a final thought, something maybe a bit more provocative for you to consider.
Well,
We established earlier that profit is essentially the increase in a company's capital, after excluding any transactions with owners, right?
increase in equity from non-owner sources.
But how you define capital actually changes how you measure that profit. There are two main concepts here.
Okay.
The most common approach is financial capital maintenance. Here, capital is defined simply by the monetary amount of net assets minus liabilities. If the monetary value goes up, even just because asset prices increase, that increase is considered profit. We count holding gains.
So purely based on the money value, what's the alternative?
The alternative is physical capital maintenance. Here, capital isn't just money. It's defined by the company's productive capacity, its ability to produce goods or services.
How does that change the profit calculation?
Well, under this view, if the cost of replacing your assets goes up, say inflation hits your inventory costs hard, you only recognize profit after you've earned enough to cover those higher replacement costs and maintain your original level of physical operation, your productive capacity. Increases needed just to stand still aren't counted as profit.
So financial capital counts profit if the money value goes up. Physical capital only counts profit after ensuring the business can continue producing at the same level.
Exactly. So the final question for you, the listener, is this. When you're making decisions, maybe investment decisions, does defining profit based purely on monetary value, financial capital, give you the most relevant information? Or does a definition focused on maintaining the actual operating capability of the business, physical capital, provide a better signal about long-term sustainability and true performance? Which perspective is ultimately more useful?
That's a fascinating question. Financial versus physical capacity as the basis for profit. Definitely something to chew on. Thanks for joining us for this deep dive. We'll catch you next time.